cause for some concern. The stock is up about 45% since the April low that came out for the first tariff announcement. That indicates a pretty high level of expectation going into this report. So any signs of weakness could be a cause for further profit, or at least some profit taking in the stock. However, I'd say analysts in general remain pretty optimistic about the company's prospects. We had the recently announced deals from the Middle East. All that points to just ongoing demand for AI-related infrastructure, ongoing growth. I'd say the setup there is pretty positive. The only question is, where do margins come in and how high are expectations given the stock strength coming into this report?
It's interesting. You're looking at NVIDIA trade at a price to earnings ratio of 45, nearly 46. On one hand, you could say that looks expensive, but very much not compared to where it was last year and even the year before. Now, if there is worry about margin pressure here, you've had NVIDIA flat to lower all year in terms of stock performance. Are investors basically telling you now, Ryan, that it's fairly valued? This is kind of as good as it gets?
Well, I think if you're looking at estimated earnings, the multiple is even lower than that. I think it is below its 5-year average. The growth outlook, at least at the moment, remains pretty strong right now. So if you're looking at something like the PEG ratio, it's one of the cheapest stocks of the Mag 7 by that ratio. So I do think people see value here. They do see an opportunity here. The growth outlook, at least for the next 12 months or so, it is still seen as pretty strong and intact. As far as where it goes from here, like I said, the stock is up 40-45% off of that April low. That's a pretty strong gain, even if it is more or less flat on the year.
All right, Ryan, thanks very much. Bloomberg's Ryan Vlastelica talking to us about NVIDIA. You can look at the forward PE estimates if you type GE, and right now it's about 31, and you don't have that big spike from last year.
I had fund managers telling me how much they loved your chart yesterday after you showed it, so I figured we'd show it a few more times again.
Ah, shucks. Thank you so much, Shanali. By the way, we're going to show that chart probably tonight in our Bloomberg Technology Special, featuring an interview with the godfather of AI, Jensen Huang, joins us at 6:30 p.m. New York time.
And joining us now, we're going to bring in Karen Pai, head of portfolio management and equities at Fiduciary Trust International, which is a Franklin Templeton company. Now, you're looking at the market. We've had some of those gains come back. We are above that 5,900 level once again on the S&P 500. How do you feel? Do you feel like you can dip in a much bigger way, particularly if NVIDIA is to outperform?
Yes, so I think actually it's a tough environment right now because we've seen the markets recover to such an extent, and valuations are now back again at around 22 times earnings. So it's harder to, I would say, to be a buyer at these levels. I think you really have to be very selective if you're going into the market at this point. I think we've been fortunate to have sort of come into the beginning of trade negotiations with a very sort of resilient economy, and so first quarter earnings, as you mentioned, were actually quite strong, and we're not yet seeing really the impact of tariffs. And that definitely was not in the numbers in the first quarter. And in fact, we probably saw some front running that's baked into first quarter earnings. And so not surprisingly, we have not seen companies really guide down numbers. I think it was really, really surprising and remarkable that only about 3% of companies actually withdrew guidance due to the tariff uncertainty. And
we thought it would be every company, right? I mean, we were all in alarm, and we thought this is going to bring massive inflation, and everyone's going to pull guidance, and potentially the sky will fall. But it doesn't seem to have happened thus far, and it looks like now that some companies are really eating these tariffs into their margins. Does that continue through the end of the year?
Yeah, so we've heard from companies talk about the concern about a recession. In fact, I think about 25% of companies actually mentioned recession in their earnings call or in their guidance. But they're also talking about efforts that they're doing to mitigate some of the tariffs, either by some price increases or by shifting production and perhaps looking for ways to increase productivity. So we're not seeing as much deterioration in terms of margins in their guidance. But we'll have to see. I mean, I think that it takes some time for these tariffs to really play out. And they're still ongoing, right, in terms of negotiations. We don't know actually where they're going to end up. I think we've come a long way since what was first presented on Liberation Day, and it's been a continuous sort of, delays here, and we have some, adjustments or pullbacks, peelbacks in terms of the tariffs that have been announced. So it's still evolving, but we still have
assume 10%
baseline.
is the
Yes,
baseline?
I was going to say, yes, we still have a baseline of 10% that companies are dealing with. And, at some point it may start to affect consumer spending habits. We haven't seen that yet, but, we may. I think we do, think that things will continue to slow down.
Companies are saying it's coming. Macy's just this morning said that they're selectively increasing prices due to tariffs. They will take a hit on their gross margin from 20 to 40 basis points. Now, you're seeing companies start to guide in that direction. What bothers me more, actually, is where we see long end rates, because that means mortgage rates will remain high. A lot of consumer finance goods will, or financing for goods will remain high.
Long-end rates, they're not that high, are they? I mean, we're not at 5% on the 30-year. We're not at 4.50 on the 10-year. It's just not happening.
Fair enough. We have been flirting with those levels, and we have, 5% on the 30-year, rather, and we've been kind of push-pulling. At what point does it matter? Mm-hmm. At what point does this have a bigger ripple effect?
Yes. So we've seen in the last couple of years that it appears as though about 5% on the 10-year was sort of a threshold in which the markets start to worry. It's also a threshold in which the narrative becomes, a concern about what's happening to banks' balance sheets, what's happening to the unrealized losses that they're carrying on their books, and also how is that going to affect, consumer borrowing and credit availability. I think that seems to be the mark that the markets are concerned about. So if we start to see that creep up, I think that might change the momentum in the market, because I do think that this is a very momentum-driven market. Yeah. I also think that mortgage rates are important, and I think that it's important for the housing market, and we've seen that creep up. That's where I think, the real impact of rates will be felt in terms of the economy.
Of course, yeah.
We'll talk about that a lot more later this hour when we talk about Fannie and Freddie as well.
Karen, great to have you on the set. Thanks so much for joining us. Karen Pay there of Fiduciary Trust International. It is Franklin Templeton Company. Shonali, I'm right there with you, worried about these rates, but they're just not going there.
You're right. 4.5, we've been living there.
Right, we're not even at 4.5 on the 10-year. We're not at 5. Every morning I wake up. This morning I said, a bad Japanese auction. We're going to soar over 5% on the 30-year, and it didn't happen.
Well, maybe if this is as bad as it gets, it's not so bad.
Coming up, we'll size up the state of Wall Street's competition for talent. Hedge fund headhunter Ilana Weinstein joins us next in the Wall Street Beat. This is Open Interest. Let's get now to high interest and look at what's making headlines around the world. Honeywell agreed to give Elliott Investment Management a seat at the boardroom table as it prepares to split into three. Elliott revealed a $5 billion stake last year and called for a breakup, blaming Honeywell's conglomerate structure for poor financial results and share performance. Meanwhile, UBS will sell its hedge fund unit, O'Connor, to Cantor Fitzgerald. The move will end a more than three-decade run of ownership by the Swiss bank. UBS is trying to minimize its riskier businesses as it faces extra capital requirements and tougher regulations in Switzerland. The transaction is expected to close in the fourth quarter. Bloomberg first reported on the sale earlier this month. And Citadel Securities posted record profit and trading revenue for the first quarter of the year. The firm's trading volume has been benefiting from increased volatility in response to Trump's trade policies. Shanali, they are knocking the cover off the ball.
They sure are, and it's posing much bigger competition to the banks. We're going to get more on that story in today's Wall Street Beat. Joining us now, Bloomberg finance reporter Catherine Doherty. Now, on one hand, this is a windfall, of course, for Ken Griffin that founded this market-making firm. But on the other hand, too, you look at net income surging 70% here. I was struck by that number because Citadel Securities talks all the time about how they can do it more efficiently. Is this the proof in the pudding, the numbers?
Yeah. I think the numbers that you're seeing out of the large market-making firms, it's all about technology. Sure, they have the people that are helping develop that technology, but they're doing it with fewer people. So their margins, if you look at and you dig right into this profit number, it is quite impressive when you're comparing it to the big Wall Street banks that are also having to deal with more regulatory scrutiny. So when you add up all of those things, and when you think about a bank having to develop their own technology, that's going to be a cumbersome process. It's going to take more time, and it might cost more for them because at the end of the day, they have a lot more checks and balances along the way. Not to say that these market-making firms aren't checking as they're developing their own tech, but they're able to move at a more efficient, faster pace.
It's all the more incredible because, and correct me if I'm wrong here, revenue was up 45%, right? And then profits up 70%. So they're squeezing more juice out of that lemon. And this is a company that's famous for paying such big salaries. I mean, they pay interns like $60,000 for a summer.
There's a lot of big figures here to look at. And Jane Street making $7.2 billion. That is what they were projecting to their debt investors for the first 3 months of the year. And this is even before you had Liberation Day in April. So these numbers that we're looking at and what Citadel's talking about in terms of their 45% jump in the first 3 months of the year, we are likely to see even bigger numbers for the second quarter. And this is following a 2024 that was record revenue and profit for these firms. And the banks, this is not to say that the market makers are setting records, that the banks are not seeing the same benefits. The banks, too, are seeing their trading. It's all on the back of huge volumes that have only continued in 2025. So we're likely to see that in 2025 full year numbers. In the second quarter. Now, the big question becomes, when does that liquidity start to dry up? The market makers will be impacted by that if trading starts to pull back and folks are losing money and not just getting in and out of various trades.
But for now, a heyday. Remember, Jane Street last year, according to your reporting, brought in more than Citigroup and Bank of America. So this is becoming hot competition. Catherine, we enjoy your reporting. That is Bloomberg's Catherine Doherty. And now we're going to shift. We're going to talk about hedge funds. We're going to bring in Alana Weinstein, IDW Group CEO and founder, because for all the love the market makers are getting, the hedge funds don't seem to be feeling as much love. What are we seeing from the multi-strats in terms of performance after we seemingly saw a little bit of a rebound coming into May? Are they still feeling it?
Okay, so what's beautiful about the multi-strats is they're not as tethered. They are not tethered, I should say, to the market in terms of whether the market is up or bound or rebounding. That's for another category, which we'll get to. They are exceptional at managing volatility and putting up consistent performance. And what I would shine a light on right now, Shanali, is we have lived through one of the most volatile periods in recent memory, as we know, over the last several months. And the fact that the multi-managers have navigated this as effectively as they have, they've stayed in largely positive territory during the duration of this period, I think shines a light on the fact that the best ones, I'll say it like this, have moneyballed the industry.
fascinating. So if you look at their ability to draw in talent, how does it compare to the rest? Because you are seeing, I mean, there's no other way to put it, crazy pay packages. You've been seeing teams lifted out for $100 million. You're looking at Ken Griffin trying to put a 4-year non-compete on in Florida. I mean, what does that talent war look like for the multistrats?
Okay, so, and that is, the multistrats are the biggest acquisitors of talent, right? By virtue of their name, multi-managers is really the, euphemism that I'm referring to. They need multiple managers to manage capital. First off, let me provide some perspective on these pay packages. It's not like someone is getting an $100 million check and walking across the street and able to cash that. Okay, part of it is a hefty guarantee, for sure, to pay that person for the period they're sitting out. Part of it is deferred. Part of it is a wallet so that they can hire a crackerjack team. And a lot of it also is on the come, where they're getting, if you normally get a 20% payout, Shonali, I'm going to give you a 30% payout up to $200 million. That's an extra $20 million, but you got to make that $200 million. The bottom line of all of this is you don't want to be beholden to what I'll call the auction. So if you're a multi-manager and you lose someone, which you inevitably will, because this is a merry-go-round, someone leaves Peter to go to Paul, or you know what? There's a lot of capacity for this strategy right now. Let me take a crack at starting my own fund. How are you going to replace that person? Do you always want to be in a bidding war? No, because then you're beholden to paying, I would actually say maybe overpaying for air quotes talent. These people are not necessarily as talented, or remains to be seen, as the headline numbers would suggest. That's a lot of money for the multi-managers to have to recoup on their investment, TBD on whether they will. Much smarter to grow talent in-house. And the best ones, like Point72 and Citadel, are a factory for what I like to call alpha makers.
That's what I was actually going to ask about. So I don't obviously know as much about this industry as Shonali, but it would seem to me that a lot of these people learn on the job. So can you foster a sense of loyalty? Does Steve Cohen do that? Does Ken Griffin do that? When you build them up from the bottom up, it doesn't help, obviously, IDW if they, make these.
Well, it does help IDW, because the reality is, if there is a culture, and that's very hard, it's not, they're not all created equal in terms of their ability to train and develop and mentor and make you, Matt, the best version of yourself that you can be at each point along the experience curve, and also give you a pathway. It's not just about coming in as an analyst and being a good analyst, or coming in as a PM and being a good PM. At Citadel, you can go very successfully, as at Point72, from analyst to PM to running a business. How exciting is that? You could be a business head at Citadel. Steve just created a new fund around one of his PMs, Turion, right? So that's a pathway where now you have, in that example, Point72 with you to raise capital. They raised $1.5 billion out of the gate, and the PM has all of the incredible resources available to him at Point72. That's not all multi-managers created equal, and that's what creates stickiness and durability.
And then the ability to build out a team under that, perhaps. One question I have is where we're not seeing as much success. It looks like the long-short business this year, for all of the volatility in the market, has not played out quite as well, and that comes after some really tough years in recent years.
Yes, so well said.
What's going on?
Okay, so, you'll see the returns in May. Breaking news, really not. They're going to be better than they were in April. So is the market. The problem with this is, one, the swings of volatility. Okay, I'm not going to name names, but there are so many examples of funds that were down in the mid-teens in April, and now we're up mid-single digits. Think about that as an LP, and think of how nervous that might make you about what's going to happen next month. And as an LP, what I'm thinking about is, how much alpha am I getting net of fees relative to the underlying beta exposure? That's very complicated. I don't want to think about that. I want alpha, and I have the multi-managers in order to access that, or I want beta, and I can pay nothing for that, right? Buying an ETF or the S&P, where the long-short funds will raise money is not in their hedge fund product. You heard it here first, Shonali. They are not raising capital. I don't care what they tell you in their hedge fund product. Where they are raising capital is long only, because there is appetite for the alpha component of a beta product.
Can I just ask quickly, I have a curveball question for you.
All right, let's hear it.
Traditionally, Harvard has been a feeder university for these masters of the universe, right? Do you see that continuing after this kerfuffle?
Well, my son goes to Harvard, so I don't know how I'm supposed to answer that question. Yes,
you went to Harvard,
I did,
right? But who else can provide the best financial minds in the world?
Well, I mean, there's a lot of good schools out there. I wouldn't say Harvard has a lock on that. What I will tell you is it pertains to talent, and I've seen this up close. Literally, I visited my son a few weeks before the end of the year, and I was hanging out with him and his friends who are finishing their sophomore year, Matt. And the aggressiveness by the top hedge funds, namely the multi-managers, in locking up these kids now for their junior summer. And the pay packages, so the talent war has gone way downstream, as we've seen, and you guys alluded to it as well earlier, are huge, even for kids, so that they have first dibs.
Alana, we got to leave it there. Wish we had more time. That is Alana Weinstein of the IDW Group.
We'll have her back, because we have to continue that conversation, right?
This is Open Interest. Stick with us.
Animal healthcare company Elanco making a pair of announcements this morning, reaffirming its second quarter guidance as well as full year. Also announcing a new CFO as the company looks to accelerate growth and take on, let's say, the Goliath of pet parasiticides. For more, we're joined by Jeff Simmons, Elanco's CEO. Elanco produces medicines and vaccinations for pets and livestock. And Jeff, great to have you on the program.
Great to be here.
I want to talk about the things that Harvey takes to fight off worms. That's Shonali's dog. Until now, you've had a much bigger rival in the market, but you're starting to gain market share, right? I think about 10%, if I'm not too far off.
That's right.
How important is this market to you, and how are you going to make some headway there?
Yeah, great question, Matt. Great to be here. Yeah, so the tick, flea, worm market's about a $6 billion market globally, growing rapidly, and these broad spectrum oral products are the fastest growing segment. We have just launched Credelio Quattro, first FDA product approved with actually 4 active ingredients, so we've got broad coverage with this product, the product's off to a really good start in the fastest growing market. We think it's best medicine, and we're leaning in. We're spending a lot of money right now on a very big launch. And, we were talking before we got started, just the willingness to spend and take care of that pet. We've never seen stronger data, and that's what's making this market so resilient in these volatile times.
I'm laughing because my dog's name is Loki.
I'm sorry, because so Kriti Gupta, a friend of ours, she also has a tiny little dog, and it's named Harvey.
But he eats this food called Dr. Harvey's, which is like a natural pet food, and that is my question to you, because this is, at the risk of sounding like crazy dog lady, I fed my dog salmon at least once or twice a month. It's gotten very expensive to do that. When you think about people who are taking care of their pets, how much are they choosing between their budget right now versus their pet's health?
It's a great question, and what I would say is, as we're looking at, the information, you got to have a portfolio of products that adds value. There is brand loyalty in this industry as well. So as we just mentioned with the Credelio Quattro or any of our products, but the willingness to spend continues to grow. And believe it or not, the kind of Gen Z and alphas and under 30, the willingness to spend is even greater than their generation, their parents' generation. So I think it's important, though. We've gone on and we've made some acquisitions of Bayer Animal Health. We've got OTC inside the vet clinic and outside the vet clinic. Large customer Elanco is of Chewy and Amazon. Making customers be able to get their innovations more conveniently is really key, and Elanco's a leader in that space.
Dare I ask, you recently sold a business to Blackstone, but you were able to use that to pay down debt, right? What is your inclination to do more M&A?
Yeah, I would say our number one priority and what we did with that is it was a really pretty neat deal, and one of the first ever is we took an animal health asset and moved it in to human health, and we monetize the royalties off from that. Our focus right now is free cash flow conversion continues to grow in Elanco is to actually pay down debt. We are right now on a continuum of accelerated, value creation by accelerating growth rates. We're globalizing the biggest innovation year we ever had last year by taking these products globally. We got a company-wide margin expansion, and then we're really working on strengthening that balance sheet by delevering. So M&A will be targeted by R&D, but the big focus will be, bringing down debt and increasing free cash flow.
How important is the pet market? How important are Loki and Harvey compared to, livestock and horses?
Yeah, Elanco has been very intentional the last 5 years, organically and inorganically, to build. We are about 55% outside the U.S., 50% in, 45% in, and then the same on kind of the pet side, about 55% pet, 45% livestock. I think what makes this industry so durable right now, and Elanco a compelling value proposition within it is a diverse business, it is durable, and it has 2 tailwinds: pets, the humanization and globalization of pets, and protein. I mean, as you look at animal protein, meat, milk, eggs, fish, that demand, as people are looking at better nutrition, we had historical animal protein consumption last year.
Since you have such a large business outside of the U.S., how are tariffs impacting the discussion you have with your international clients?
You know, it is something we're in constant dialogue. We're a value-based company. We're all about making farmers more money globally, as vet clinics and pet owners as well. I think we took a very prudent and proactive approach at earnings a couple weeks ago by saying, hey, the current global tariff situation and all scenarios we see going forward, we encompassed inside our guidance, which we reiterated again today. We see accelerating growth and margins in that guidance. So I think investors appreciated that, but I think a global business, we're pretty balanced overall. Still, the majority of innovation and the majority of manufacturing is still based here in the U.S.
Our Bloomberg intelligence analyst, Ann Hunter Van Kirk, gave us some intel on this sort of parasiticide market. And I think it's interesting that Zoetis has Simparica Trio, and you have Credelio Quattro, and I was wondering, why not just go straight to Cinco? Did you not think about that?
Our pipeline's full of innovation coming, all right? We're going to have a consistent flow of innovation.
What's with the numbers there? Is that like the amount of things it can kill, or?
Yeah, it is coverage overall, and there's differences between, but we've got 4 active ingredients. Again, we've got broad coverage, tick, flea, as well as that broad coverage of numerous worms. And what do ultimately pet owners want? They want, hey, we want coverage, we want convenience, we want it delivered, we want to assure that it's something I don't need to think about. And
edibility. You got to be able to convince the dog to eat those things, right?
You do. And I think we're seeing some great receptivity back to the 10% quick taking of share of this market early into the vet clinics. Is the palatability really matters, and we're seeing that as another, we believe, differentiation.
So that's the trick.
Is that what helps with olive oil?
Everybody has their tricks.
Exactly.
Jeff, thank you so much for joining us. Fascinating business. Jeff Simmons there of Elanco. Let's get a quick check on what's going on in the markets right now. It's been a bit of a drift after an initial spike. We're obviously waiting for NVIDIA results, but the S&P is now down almost 0.2%, still above 5,900 at 5,912. So we're holding above that level.
We did lose the gains of the morning. We firmly lost the gains.
Instantly lost those gains. But yesterday we were up 2%. So you can see the NASDAQ, really little change there as well. It's all about NVIDIA, but we had a bunch of retail earnings.
Yeah, Macy's turning around. That's pretty interesting. A look at some stocks moving under the hood. It's been a really interesting trade for the consumer. Abercrombie & Fitch has been soaring after the retailer posted first quarter results that topped estimates. Macy's now climbing after results show that the department store's new strategy is starting to pay off. That's even as they say they will pass some prices off to the consumer, Matt. Okta falling. This has been an interesting company. This cybersecurity company gave a weaker than expected outlook. We're continuing that earnings mixed bag. We're also continuing a story about M&A because insurance broker Acrisure makes a new billion-dollar acquisition to expand its fintech services. This has been a big market for deals this year. We're going to speak with Acrisure CEO Greg Williams next. This is Bloomberg Open Interest. It's been an M&A Tuesday and an M&A Wednesday. Acrisure is buying Heartland Payroll Solutions for $1.1 billion from Global Payments. Global Payments has been deal-making a lot this year as well, you might have noticed. But the insurance broker is hoping to expand its fintech services to become a one-stop shop for customers. Joining us now, Greg Williams, Acrisure co-founder, chairman, and CEO. It's been an interesting run for you, Greg, because, of course, you raised money at a well over $30 billion valuation pretty recently. You used some of that money to buy this Global Payments unit in cash. What does it say about what you want to become as a company?
Well, I think this journey, Shanali, this journey started for us really 5 years ago when you start thinking about we made a $400 million investment in an AI platform in 2020, and that gave us the data insights and the information about a marketplace that we didn't have at the time, that we've been building over the last 5 years. And now you think it and look at what we have. We have 200 billion data elements of information about a marketplace. We have 6.3% of every business in America is an Acrisure client, as we see here today. 97% of those business clients have 100 employees and less, and so they have lots of, I'll call them non-discretionary needs as it relates to insurance and other financial products and services. And so this transaction really is just going where our clients want us to go, in the sense that if you poll the marketplace, and we do a lot of surveying, and you ask them, would you like to get all these financial products and services that insurance and cybersecurity, payroll, payment processing, wealth management, et cetera, the list goes on and on. Would you like to get them from a dozen different parties, or would you actually prefer to get them from one? And increasingly, the clients, 89% of them will say, we'd like to get them from one. So really just stepping into the gap and stepping into the breach and responding to the client's needs, and doing that with, again, an AI platform that just gives us deep insights, predictive modeling about who's likely to buy what. And this acquisition really fills that product need for us.
Greg, what's interesting to me, and by the way, I think you're speaking to a lot of big trends. Small businesses want to save costs, so they are consolidating a number of vendors they go to. It's probably one of the bigger reasons you're seeing M&A in the fintech space so largely. But when I spoke to you about this deal, I also asked you about your potential for an IPO, and this is what you said to me, that you are considering spending time and money to be prepared under the right possible conditions. Now I ask you, what are the good conditions for you to go public? Is that something that is in your near future?
Well, certainly, as I like to describe it, look, we've got to preserve optionality. The size of the business today, it's 12 years ago, this was a $38 million revenue business. Fast forward 12 years, it's over $5 billion. And so it's a 48% compounded growth rate over a dozen years. The size and scale of the business today, the number of stakeholders that we have, really, I think, if you just, again, size and scale alone kind of sets you up to where you kind of know what your destiny is going to be. And so we've worked diligently to be ready. That's still a work in progress for us, so it's not any declaration that we're ready to go. It's still very much a work in progress. I think that is our likely destination at some point in time. And so, A, the company's got to be ready, first and foremost, and B, market conditions have to be right. And as we're getting ready, we're obviously closely monitoring markets to determine what's the right time.
I wonder about what you're hearing, Greg, from small businesses, from your clients about this economic environment, because as we've been saying today, there was a lot of people absolutely losing their minds over tariffs, and now obviously over this new one big beautiful bill. But it's not coming out so negative in the hard data, and it looks like consumers are still hanging on. Like, what intel are you gathering from the CEOs that you talk to every day?
Well, it's interesting when you look at our marketplace. Again, 6.3% of every business in America is an Acrisure client. So we have daily interaction with the marketplace, and I would tell you, Matt, the sentiment is not as negative, at least in our world with our client base. The sentiment is not as negative as you might expect. The volatility is not quite what you might expect. It's more bullish than bearish by far in terms of their outlook for what's going on in their world and their respective companies. And so we've continued to lean in that, again, stay very close to market sentiment. But what we're seeing in primarily this SMB marketplace, as it, referenced in terms of the size of our clients, predominantly the size of our clients, it's pretty bullish and high degrees of confidence going forward.
But, I want to pull up the Russell 2000 just year to date as a barometer of how investors have been feeling about small and medium-sized businesses. It's still down almost 7% on the year. We don't have the most recent NFIB reading of a small business optimism, but through April, it deteriorated for 4 straight months. And when you have that kind of sentiment hanging around the hoop, how is it changing business decisions from small and medium-sized businesses that have been the lifeblood of the American economy?
Well, I think, Shanali, that is the kind of the key is that, what we've done is we've focused on, I'll call them non-discretionary products. And so insurance, payroll, payment, cybersecurity, and the likes. And so it really is not, it's not an existential, or it is an existential issue, is that if you're in business, you're going to buy those products and services. It's at what scale or what spend are you allocating to those things, but they are non-discretionary products, and maybe perhaps that's why we're seeing more optimism than maybe the market and the broader market seeing. Is that at the end of the day, we are dealing with them in a non-discretionary product environment. So I think that's probably why we're seeing it, what we're seeing, but those would be the things I would cite most notably.
Greg, great to have you on. Really good intel to get from you. I appreciate it. Greg Williams there talking to us from Acrisure. Coming up, President Trump says the U.S. government would retain guarantees on Fannie and Freddie even when they become public firms. And he was explicit about it. This is Bloomberg Open Interest. Shares in Fannie and Freddie rising today. That's after President Trump posted about the mortgage lenders on Truth Social yesterday. Donald Trump saying the U.S. government would retain guarantees on Fannie Mae and Freddie Mac even when they become public firms, which he's working on. For more, Bloomberg Intelligence analyst Ben Elliott joins us now from Washington. He covers mortgage lenders. Ben, it's interesting to say that the shares are rising, and then talk about them becoming public firms. What is the state of Fannie and Freddie right now?
Yeah, so look, definitely the hardest part of getting these companies out of conservatorship is convincing agency MBS investors that there's still no credit risk involved when they buy securities issued by Fannie Mae and Freddie Mac. So hearing the president say that they definitely intend to have the government still have a role is obviously very positive, and you've seen that in the price action today in the commons and the junior preferreds. But I think sort of another interesting way to look at this, right, is if you look at how agency spreads have reacted today and during the president's prior tweet, they didn't really move that much, right? So the actual bond investors here are just assuming that the status quo is going to be maintained even before the president tweeted what he did last evening.
So you have the president, maybe even the Treasury Secretary. They're talking about him a lot in this regard. You have the FHFA director that is preparing Fannie and Freddie for a potential for public entrance. What would lawmakers say? Because realistically, the big fear about releasing Fannie and Freddie into public markets in this way is mortgage rates and whether they will be untethered. What do you think?
Yeah, so lawmakers have perpetually been unable to come to sort of any kind of agreement on this issue. They've had, 15 years plus to do something about it. At this point, I think the administration feels they have quite a bit of political cover to just go ahead and do what any administration was able to do unilaterally. But I think if the president didn't have as much support as he currently does in Congress, that they would be a little more trepidatious about sort of getting out over their skis on this.
Can you just explain, though, Ben, what it means to go public? Since I can already buy and sell their shares in the public markets, it's a little bit confusing to a lot of people.
Yeah, so what's interesting, right, is if you look at HDS in the Bloomberg terminal, you're not going to see everyone who's a holder of the common stock disclosed there, and that's because a lot of funds have decided that since the shares don't have any sort of voting right, there's really no economical ownership implied from owning the commons, that they don't have to disclose their stakes in the common shares. And that's because the government stake is so overwhelming that it would basically dilute sort of any value that the commons currently have.
I'm just going to ask the unpopular question here and say, you have a lot of hedge funds, very prominent hedge fund managers. Many of them are large backers of Trump that are
Bill Ackman?
Bill Ackman, John Paulson has been a historical owner. They have been looking to see a privatization for a long time, since the last Trump administration. But does it come at the expense of Main Street? Ultimately, the big question is, does this make borrowing costs higher for Americans looking to buy homes? Can you be convinced that it won't?
Look, the status quo has worked very, very well for at least a decade. So anything they do here really is likely to rock the boat. There's no reason to assume that borrowing costs, for instance, would go down as a result of privatization. So even if they stayed the same, that would be sort of the best outcome for the administration.
Ben, we thank you so much for your time. That is Ben Elliott from Bloomberg Intelligence. And it's interesting because I want to actually show you what FICO is doing year to date. It's down almost 20%. It's snapping back today on a Baird upgrade. But remember, the reason it has been falling in part is because you have the FHFA director saying that credit score cost decisions are coming in weeks. They are not happy with FICO. You have an administration member very, very directly blaming FICO here on putting the pressure on consumers when it comes to their ability to borrow. And FICO, remember, has been a kind of a thorn in a lot of lenders' side. It is kind of the only game in town, as you know. So it's fun stock to watch these days.
Anyone who's dealt with it has been, I'm sure, frustrated with it. So it's understandable that a populist government would have issues with, I mean, that's a way to win points straight away, is attacking FICO. I'm just marveling at Fannie Mae. I mean, we talk about going public and how will public markets react, but you can buy and sell these shares on a regular basis, and they are up 664% in the past 12 months.
It has been an enormously popular hedge fund trade, I've got to say, and a retail trade these days, too.
All right, let's get a check on what's going on in these markets other than mortgage lenders and credit score agencies. We're looking at red arrows, and it's interesting because futures were so flat. We did then have a spike up into the green in the first few minutes of trading, but the S&P 500 is now down 0.25%. Still over 5,900, but near as damn it to it. And the NASDAQ is also falling, only 0.1%. But it's NVIDIA that we're also focused on, right? And you can see see those NVIDIA shares down about 0.2% right now at $135. Those earnings coming out after the bell, and that is obviously going to be the main focus of the day.
Absolutely. But you do have, to your point, not only a reversal of the S&P, almost every sector is in the red right now, every major sector. So really a reversal of breath going into that NVIDIA print. The other question, Matt, will NVIDIA save the rest of the Mag 7? There are doubts behind that.
All right, coming up tomorrow, Shonali is live from the Goldman Sachs Leveraged Finance Conference in California, speaking with the company's vice chairman, Robert Kaplan, the head of global credit, Christina Minis, as well as the MoneyGram CEO. And that's a lot. We're looking forward to it.
Thank you. We'll see you then. This is Bloomberg Open Interest.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, all eyes on $3 trillion NVIDIA as it gears up for earnings after the closing bell. Can it profit margins weather the Chinese export restrictions?
Plus, we speak with the CEO of identity software player Okta following its own earnings, posting a conservative forecast.
And a SpaceX Starship rocket lost control and disintegrated during a test flight last night, the company's third setback in a row. But first, Ed, we check in on these markets. Look, gains disintegrating here too. We're currently off by about 0.2%. Look, we are treading water ahead of the all-important macro event. Whether you think that's the Fed minutes a little bit later today, or whether you think that that is the all-important NVIDIA numbers after the bell, we are on tenterhooks, Ed.
Yeah, Nvidia's a little bit softer, right? Down 0.4%. On a year-to-date basis, it's just in positive territory, up 0.5 percentage point. Everyone I speak to, Kara, I think you're right. Nvidia is a macro-level event when it comes to its earnings. So let's get to what we can expect from those earnings later today and bring in Bloomberg Intelligence senior analyst Kunjan Sabani. In his earnings preview research, Kunjan says investors should expect a strong quarter, and Kunjan, a big part of that is a ramp in GB200 and where those GB200 units are going.
Definitely. I mean, the demand expectation for GB200 from our channel checks continue to exceed what we thought before. And one key important point for this earnings is this is the most noisiest quarter we have seen in terms of NVIDIA expectations. The 2Q numbers have been brought down to take the impact of the China ban, but there is still a lot of confusion on that magnitude. So we think the beat and the miss on the absolute basis for this quarter should be much less important. Rather, the more important thing should be the second half commentary around the GB300 transition, the clarity on the new China chip, and if bonus points, if we can get some color on the 26 demand outlook from Jensen.
And from Colette Kress, the CFO, how much do you need to hear from her about the margins going back to a 70% or so level at the moment? Because they have been under pressure, Kunjan.
That will be a lot more important. We think margin will take a headwind impact, just like AMD did in either this quarter or next quarter, but that should be just a one-time temporary impact. But you're right, if they can give any commentary in the confidence of getting back to the mid or even low 70s by Q4, that would be absolutely positive.
Kunjan Sabani, it's going to be busy. We thank you so much for Bloomberg Intelligence. Let's discuss now NVIDIA's expectations and how they fit in with the broader market, the macro perspective. Ayoko Yoshioka joins us, Portfolio Consulting Director at Wealth Enhancement Group. And look, this is a macro event. How do you manage what Kunjan has clearly said is going to be noise on the first footing of the numbers?
Sure, Caroline. I think, we put this into short-term versus long-term context. I think in the short term, yes, we might have a noisy quarter, and maybe this does not allow NVIDIA stock to break out of its sort of 100 to 150 range that it's been in over the last year. But I think over the long term, I think what we're all looking for is that macro impact of the AI theme. Is it going to continue? Is the demand really there? And I think the answer is going to be yes.
In the short term and the long term, for me, the question is what happens for NVIDIA in China?
Absolutely. I think, everybody's aware of the H20 export ban and whether or not, NVIDIA is going to potentially come up with a sort of new redesigned chip for that market. I think they're likely to work on it. They've done it before, and I think that's going to help. But that's the big question, is what is China revenue going to look like for NVIDIA over the next 6 months as well as next year?
And Ayoko, what's notable is Ed said at the top, this is a stock that, yes, you can see has rebounded hard since its lows in April, up 40%. We're basically flat on the year. And so how are we thinking about the AI trade more broadly at this moment? Geopolitics, does that counter what has been the bubble driver of the last couple of years?
Yeah, I don't know if geopolitics really counters it. I mean, clearly the tariff situation is weighing on a lot of tech companies as well. And so I think it's contributing to a lot of the noise that we're seeing here. But I think over the long term, we know that the build out for the infrastructure for AI continues. And, NVIDIA continues to benefit from that.
And we've already heard a lot about that. Boy, the Middle East deals, Saudi Arabia, UAE. What more can Jensen deliver for you today?
I think just the overall outlook regarding, additional use cases. How much are, NVIDIA's chips going to be utilized in robotaxis and, humanoid robotics? I think those are additional areas of growth that can continue to propel NVIDIA's stock higher over the long term.
What is this like for you is a moment in time as an investor. Like, I'm trying to think about something that's analogous, and for me, the earnings call, it's a little bit like Tesla and Elon in that you get the earnings release and you read through it and you think, okay, and then there's a pre-prepared remarks, but actually it all kind of hangs on the Q&A, and this man called Jensen Huang, who people call the godfather of AI, and some people call him something different. Just when you're at your desk, how do you endure that? How do you play it?
Sure. I think we're all listening for just the demand cues, the supply constraints, really trying to understand the longer term sort of nature of this thematic. Cloud computing was something that came about and was very long and in duration in terms of its growth, and it continues, right? We want to know how long AI's build out is going to continue as we transition from training to inference, and how long that continues to benefit NVIDIA.
Do you pay any attention to the technology story? Like, if they tell you we have a new timeline for a product, do you react to it?
Only to the extent that it continues to propel the AI story. I mean, I think more so the more important things that came out were like the NVLink Fusion product that they talked about, just networking and allowing for additional CPUs and ASICs to connect to the GPUs that NVIDIA produces. I think that allows for the overall AI growth story to continue for much longer, and it expands the total addressable market. So we like hearing things like that. New additional sort of chips, things that will follow, whether it's Rubin following Blackwell. We'd like to hear how that's going and the impact on margins from a timing perspective. But the quarterly fluctuations aren't going to sort of deter our long-term thesis there.
And are you fully over the anxiety around DeepSeek? Because today the R1 model has been upgraded, we understand. Did Jensen do enough in terms of clearly showing that inference is where it's at, Ayoka?
I think so. I think we're seeing that across, many sort of, hyperscalers talking about this. And, I do think that the DeepSeek story, although it was sort of jarring at the beginning, I think a lot of that really just came out of the fact that it came out of China. I think if it had come out of the United States, it might not have been as jarring. But again, I think this really just sort of expands the overall, addressable market.
I think the sensible place to end it on is a sort of chicken and egg debate. What's more important for investors to get a long-term picture on, NVIDIA or the hyperscalers and their CapEx figures? Because we've kind of done a juggle between the two.
It's a great question. I think it's the CapEx spend. One of the things that we continue to monitor is the overall CapEx spend from the hyperscalers, and it continues to grow. The growth rate has slowed down, and we expect that to slow down going forward. But that spend in terms of dollars continues to be very large, and that will propel the overall infrastructure and the speed at which we all adopt AI.
Jensen Huang would disagree with you. He'd say, I told everyone what I'm doing for 5 years so they can make better plans. Ayoka Yoshioka, Portfolio Consulting Director at Wealth Enhancement Group, thank you very much. Now, coming up, the CEO of Okta joins us to talk about the company's results and why it's taking a prudent approach to its outlook. That's next. This is Bloomberg Technology. Okta shares down nearly 14% today after the maker of identity management software gave a conservative forecast for the futures. Okta's first quarter revenue was up 12% year over year, and subscription backlog suggests a longer sales cycle. That's according to our own Bloomberg analysis. We're joined now by Okta's CEO, Todd McKinnon. Let's get the market-y bit out of the way. This conservative guide. Do you agree with the interpretation that it's conservative? And if so, what made you be a little more cautious?
Well, I think we're talking about guidance on very short term. So 1 quarter is very short term. And so, yeah, we would look at the world right now and we say there's some uncertainty with tariffs and trade policy and the future of the economy in the short term. And so we give a prudent guide, but that doesn't change our outlook for even the medium term, the long term. We're very bullish on the opportunity, very bullish on the business. And if you look at the Q1 numbers, we have a lot of reason to be optimistic in Q1 over the medium and long term.
We're talking about identity and access management, like that's the field you're in. But one tailwind that I keep hearing about is this issue of AI memory and AI agents. In other words, if an AI agent is going to be super useful, it needs to talk to many other agents, but it means the person, the human at the center of it, has to give away a lot of their information. That may be an area where you come in and make it more secure. Is there an opportunity there?
Well, what identity and access management is about is making sure the right people have access to the right information. And traditionally that's been business applications, web applications, mobile phones, mobile applications. And what's happening in this AI revolution is that now machines are accessing information more and more than ever. So it's not only about getting the people the right access, but you have to get the computers the right access. And we're very good at that. We have thousands and thousands of customers that trust us every day to make sure that their machines and their software systems have access to the right information. And now AI is turbocharging that. We're moving in the industry, we're moving from prototypes. Everyone's prototyping these agentic systems and these customer support reps and these sales reps that can work on people's behalf, and they're putting them in production. And that means they have to have this access to real customer data, real user data, and that's where we come in. We can help them do that seamlessly and securely, and most importantly, make these prototypes work. And that's what businesses want. They want AI to work for them, and we can help them do that.
What about the public sector? How much do they want it? Because I know you've secured some decent deals with them of late.
Yeah, it's no different. Every government agency is trying to get more efficient and more effective with their IT, and the AI revolution is part of that. In fact, in Q1, 4 of our top 10 deals were with public sector agencies, so we're seeing very robust demand there, and it's for the same reason. They need to be secure. Our business is about identity, and what people are understanding is that identity is security. To be secure, you have to have a good identity system, and then when you start to do the agentic workloads and move these projects from prototypes and proofs of concepts into production, you really have to control access to the data, and that's what our customers are telling us we can do for them.
And of course, the drive for DOGE, for efficiency, was about tech adoption, but it was also about cost cutting. How much do you think that there is this headwind, this caution around, well, maybe a pushback on some of the contracts that you have within the public sector?
Well, like I said, 4 of our top 10 deals and 2 of the top 3 deals in Q1 were in the public sector. So what you're seeing, especially at the U.S. federal level, is organizations are looking to be more efficient and more effective. And that means looking at all their spending, but most of their spending is on legacy technology. So they're managing on-premise software, and they're paying massive bills to people to support and maintain that software. And the industry of cloud computing and AI offers a viable alternative. And Okta, inside of that, is the key layer in securing and managing it. So if you want security and you want efficiency, we're a required thing, and that's what's driving some of the success in that part of the market for us.
Okta has been trading for several years as a public company. When was it founded? Just very quickly.
2009.
You just talked about legacy tech. Could you just talk a little bit about what doing business is like in this environment? So there are lots of new names in this field. There are lots of new names who want to be your customers, and they're kind of used to negotiating with other people they may or may not know in this sort of Silicon Valley orbit. You've been around a little longer, and I just wonder what that's like.
Well, I think the most exciting thing about the current age of technology is that we are very established. We have $2.6 billion of revenue and growing quickly, and we're very profitable. In fact, in Q1, we had record profitability. So in our space, we are the clear leader, our space of independent and neutral identity management. And now there's this AI revolution, and it's opening up vast new markets for every technology company. So it's like, how do you defend what you've done very well while at the same time investing for the future and innovating and making sure you capture this massive new opportunity. It's quite exciting, but it makes us really double down and stick to our past history of innovation and defining the market and extending what we've done into this whole new world.
At the top of the segment, we referenced subscription backlogs. Why is there a backlog, and how does it get unfolded?
Well, we're a cloud service, so people pay us a recurring subscription. So we prove value to them, and they reinvest in us over a period of the contract duration. That's the way business works now, and it's a good trade-off between value delivered to the customer and a vendor like us being able to capture that value we deliver.
Okta CEO Todd McKinnon, we really appreciate you coming on and talking back against perhaps some of the narratives around the Doge issues. Meanwhile, coming up, how YouTube is making itself the centerpiece of the living room, your TV. More on that next. This is Bloomberg Television. Apple set to release a dedicated gaming app across its devices later this year. It's all according to sources. The feature is set to debut at this year's Worldwide Developers Conference on June 9th, just a few days after Nintendo's Switch 2 release. For more, Bloomberg's Mark Gurman joins us now. And is this defense? Is this offense, Mark?
Yeah, thank you for having me. Apple's been working on this for quite some time. Over the past few years, they've been trying to push iOS and macOS as better gaming platforms. And you know, the Mac has come a long way. There are new porting tools for developers to move their apps over from PC to Mac, but there's still a long way to go. You've seen all sorts of different cloud gaming services and on-device gaming services over the last few years. You've seen some from Google. Microsoft has tried this, and what Apple's trying to do with this app is create one unified place where developers can pitch their apps with new editorial content, a unified place for gamers on all of Apple's devices to go to when they want to launch a game, view achievements, view leaderboards, connect with other players online. And so this new service, this Apple Games application that will be pre-installed on Apple's devices beginning at the end of this year, will be that new place to do so.
Mark, I've struggled for many years with gaming through Mac OS. I find this so interesting. On the titles themselves, we're not saying, though, that Apple is going to become a developer and publisher of games specific to its own platform, right? It is still a marketplace and a way to monetize access through other people's software and titles.
Apple bought a two-person game studio. I believe the app is called Sneaky Sasquatch. It's one of the more popular games on the Apple Arcade subscription service. So they bought that, but I don't anticipate them to go a lot further than that in terms of in-house games. Maybe they'll buy a few other smaller studios, but I don't anticipate them to go down the route of developing their own games, investing billions of dollars into that. What I do expect is for this new games app on Apple devices to be a central way where people access games. 2/3 of Apple revenue from the App Store, probably north of $12-13 billion a year, comes from games. So games is super important. They want people playing more games. They want people downloading more games. They want people buying more subscriptions within games, and having a unified place to access all those titles could potentially help with that.
Gaming is important to Apple's business model, but how important is Apple to the gaming industry? Just what sort of market share does it have? Give us a context, Mark.
If you think about it, the iPhone is probably the most popular gaming device on the planet. You can now get AAA titles on there, Resident Evil, Fortnite is back on the App Store now after a few-year reprieve after that lawsuit hit new levels with a...
I'm going to jump in here, Caro, because I think we had a technical issue on Bloomberg Technology, but our thanks to Bloomberg's Mark Gurman. Another story we're tracking, YouTube has spent the past few years trying to make itself the centerpiece of the living room. And now creators are finding themselves making longer shows to meet viewers where they are, in front of their TVs, where YouTube is now the TV service of choice for viewers of all ages. Bloomberg's Lucas Shaw is here for more in his Business Week piece that's out today. I found this so interesting in the context of different genres. I think about where I consume and what I consume on YouTube. What is the kind of conclusion reached in this Business Week piece, Lucas?
Well, I think for most of YouTube's existence, people thought of it as a short-form video service that people watched probably initially on laptops and desktop computers, then primarily mobile phones. And over the last 3 to 5 years, there's been a pretty dramatic shift where the television is now the primary device that people use, at least in the US and increasingly in other countries. And as a result of that, or a little bit of a chicken and the egg scenario, but the length of video that people are watching is getting longer, whether that's a 3-hour Joe Rogan podcast or a 25-minute sitcom. And the latter is something that really interested me because I also think most people think of YouTube as a place for sort of crappy, unscripted stuff. And increasingly, there is scripted programming that people actually watch on YouTube.
Slopfest, that's what you say in the piece. And this idea that it has slop is something that perhaps others in the industry try to portray, but how have they pushed back against that? How are we seeing that reverse in terms of trends or not, Lucas?
Yeah, I mean, look, there's been this ongoing debate as to whether there is quality programming on YouTube, right? They had what were their brand safety scandals a little less than a decade ago, where you had ads run against unsafe materials. You had a lot of their biggest stars get in trouble. You had Jeffrey Katzenberg start this service Quibi that was supposed to be, YouTube, but YouTube-length videos with sort of Netflix budgets. That didn't work. And the truth is that for most people, what they see on YouTube is quality. If you asked someone who watches Hot Ones, the chicken wing eating question show, that's a talk show that young people care about a lot more than Seth Meyers, for example.
Lucas, just real quick, I couldn't name, though, a single YouTube original. I have HBO Max because of The Last of Us. I go to Apple TV because of Silo. And that's the reason I have all of these different platforms and subscription bills every month. What's YouTube doing there? Some name recognition programming, original programming.
Well, but have you heard of Hot Ones or Mr. Beast?
Yeah,
those
different format, but good example, right?
So, look, we're not at the point where they're making a Last of Us for YouTube. The budgets are too big for that to make money on YouTube. I think there's a belief that we may eventually get there, certainly with the use of AI bringing the cost down. But that is the kind of the big white whale for YouTube, if you will. Or YouTube would tell you that you can still watch The Last of Us on YouTube. You'll just do it via Max and kind of buy Max as from the YouTube Google channel store.
The data, it talks. Lucas Shaw. So great to have you. It's a great Business Week piece. Meanwhile, coming up, AI has superchanged and supercharged the demand for electricity. And a partnership between NVIDIA and Navitas Semiconductor is the maker of energy-efficient chips has Navitas shares soaring. We're going to be speaking with the CEO, Navitas, Gene Sheridan. This is Bloomberg Technology. Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. This is what financial markets look right now, zeroed in on the technology sector. We are basically, as Caroline said at the top of the show, treading water. We're flat on the NASDAQ 100. We're slightly softer on the Philadelphia Semiconductor Index. And that story is almost solely NVIDIA, which reports earnings after the market close. It's a stock that is treading water right now, completely flat on a year-to-date basis. It is higher, but marginally less than 1 percentage point. And what we're looking for is some sense of, in the short term, the China story. How have sales been impacted? Remember, a $5.5 billion write-down in the quarter gone relating to the lack of being able to sell H20. What does that look like going forward, Cara?
It's going to be an interesting one. And as you say, look, all eyes on that report tonight. But that attention is actually spilling over to others in the AI supply chain, Ed, including Navitas Semiconductor, a maker of power-efficient gallium nitride chips that go into everything everything from laptops to EVs and now data centers. Last week, news of a partnership with NVIDIA sent Navitas shares absolutely soaring, 164% in a single day. Since then, added more than $1 billion in market value, tripling its size as the rally continues. And Navitas CEO Gene Sheridan joins us now. Gallium nitride, silicon carbide. How is it going to change the world of data centers?
Good question. Well, data centers are completely changing the world as we know it. It used to be data centers required just a few hundred watts per processor or 10 to 20,000 watts in a server rack. That's the building block of a data center. AI is changing that completely. We're now talking about hundreds of thousands of watts, and in the future, a megawatt per server rack. How are we going to deliver that kind of power? Silicon chips just can't do it. They run out of steam. Gallium nitride and silicon carbide can offer up to 10 to 20 times more power and do it more energy efficiently with faster charging, faster power. These are the key technology chips to power the future data center.
And Gene, as we mentioned, been selected by NVIDIA for this partnership going forward. How's your supply chain? How's your ability to suddenly meet this level of demand?
We have lined up significant capacity. We've seen this coming for the last few years. We've been working on gallium nitride and silicon carbide for over 10 years. We have excellent supply chain partners, TSMC with gallium nitride, X-FAB with silicon carbide, significant capacity available today in 6-inch, going to 8-inch in the coming years. So we've got a lot of capacity lined up. Now we're working with NVIDIA on the development side. There's a lot to do in development to enable what they call the 800-volt data center. This data center architecture is not only going to save energy and use our chip to make it more energy efficient, it's going to enable that megawatt capability up to 10, 20 times more powerful to handle the future AI processors for the next few years.
Gene, your company's stock's been on a wild ride, hasn't it? Since the announcement of the deal, largely by association, probably, right, with the name NVIDIA. But can you give us something tangible? Like, what's the dollar value of this relationship to Navitas? What's the sort of sales growth trajectory just from the agreement you've put in place with NVIDIA?
Well, we're already shipping our high voltage GaN chips and silicon carbide chips into data centers today. We have about 70 opportunities in the AC to DC converter for the traditional data center of today. That's already growing, and that's going to drive some short-term growth for the company. But this announcement is really about tomorrow. We're going to spend the next year in development with NVIDIA and others, creating the key technology or building blocks for this 800-volt data center, this megawatt server rack power. These systems won't come online until maybe late 26 and really be ramping in 27. So it's not a short-term play, but we do have solid business in the near term that has us already engaged with NVIDIA and others. And we're really excited about making this next generation data center happen over the next 12 to 18 months.
We said at the top of the show that you've added almost $1 billion of market cap in the last 7 trading sessions, and the company's value's tripled. As its CEO, what's that like for you?
Well, we went public a few years ago as an early stage public company. I've learned to ride the highs and the lows and not get too excited about either extreme. So I think the market's going to do what it's going to do. But we keep our heads down, focusing on building a great next generation power semiconductor business. If we can keep partnering with companies like NVIDIA in key segments, data center is a top one for us. We're also working on mobile chargers. We're also working on electric vehicles, changing solar inverters, partnering up with some of these key guys. That's what gets me excited. That's what's going to drive our business. And we're super excited about the NVIDIA one to really create these future data centers.
Gene, how are you navigating also the politicization of all of this? The idea that people want US data centers, but they're also willing to then go and partner in the UAE and Saudi Arabia, and issues around access to China in that way. How are you thinking about the global footprint you'll have?
Yeah, it really is deglobalization in such a big way. I think we're starting from a good place. Taiwan is a great central location, neutral, if you will, to serve the world. TSMC is the biggest and best out there for the gallium nitride chips. Our silicon carbide at X-FAB is actually manufactured right in the United States, in Texas. There's a lot of work to do here in the United States to upgrade the grid, and most of the data centers in the world are concentrated here in the U.S. So made in America. At the chip level, made in America for the data center and for the power grid upgrades is a perfect fit. But we're not going to stop there. We're looking at bringing up wafer fab and manufacturing partners all around the world, so we have geographically diverse footprint, so we can deal with whatever the geopolitics are, as well as whatever the localization needs are. So there's a lot to do in our expansion. We've got a lot going on to expand that footprint.
Gene, you said this partnership with NVIDIA bears fruit late 26, early 2027. Does that mean that you'll be involved in some of the projects NVIDIA announced in the Gulf states, Saudi and UAE, and some of its onshoring activity here in the United States, projects like Stargate, for example?
Well, we'll work at the power chip and power module or power supply level. So we create kind of these building blocks, the building blocks that move that power around, allow the power to happen efficiently, keep the data centers cool. Where they take those building blocks, the beauty is I don't have to customize them from one region to the next. They can build these all around the world, and they'll ship and move those chips and modules easily without my involvement. So we don't really need to be impacted by those international moves.
Navitas CEO Gene Sheridan, thank you so much for joining us on Bloomberg Technology. Caroline.
Time now for Talking Tech. Ed, first up, Shein is said to be considering switching up its planned IPO offering, moving from London to Hong Kong. That's according to sources. The fast fashion retailer is said to have shifted its plans because the approved process is dragged. Shein initially planned to list in the United States, but was ultimately derailed amid supply chain and labor scrutiny. Plus, Instacart has named Chris Rogers its new CEO, effective August 15th. He will replace current CEO Fidji Simo, who announced earlier this month that she will leave the company for a newly created role at OpenAI. Simo will remain chair of the board at Instacart. And a U.S. district judge has ruled that Elon Musk will have to face a lawsuit that claims that he wielded illegal power in cutting federal jobs and spending under Doge. Now, while Musk has been the public face of Doge, he's denied he holds a formal position or has any authority to direct agencies to carry out the president's cost-cutting agenda. Ed.
We stay with Elon Musk. His SpaceX Starship rocket launched last night, but exploded mid-flight, marking the third consecutive setback for the company. Still, Musk seemed enthusiastic despite the outcome, writing on X, "A lot of good data to review. Launch cadence for next 3 flights will be faster." For more, we're joined by Bloomberg's Sana Pashankar, who was up late covering the minute-by-minute of this 9th scheduled test flight. I think it's really important, right, Sana, the context that the Super Heavy booster, as a part of the Starship combined system, was a reflight. It had flown on the 7th test flight. And the way that SpaceX is always going to say is that it's a success because of the data gathered. Give us the kind of high-level details we need to know about Mission 9.
Yeah, totally. So essentially, everything seemed to be going smoothly at first. The giant rocket thundered off the launch pad at around 6:30 p.m. In Texas. But about half an hour into the flight, the rocket experienced a leak in its fuel tank system, which kind of caused it to lose control and spin out as it hurtled back towards Earth's atmosphere. And at the same time, it missed one of its key objectives, which was to deploy dummy Starlink satellites, because the door to the rocket wouldn't open, which would release those satellites. So it did miss that key objective. As you said, it was able to reuse a booster from a previous flight. So as we've seen in some previous Starship launches, they were able to catch those boosters after the rocket launch. And so that was using one of those previously used boosters, which was a first for the company. However, as the rocket took off, the booster actually ended up being lost as well and exploding, although they weren't meant to retrieve that one to begin with. So overall, there was a win with the use of the booster, but they missed a few key objectives.
And Sana, what was interesting is we had been expecting an all-hands style talk, right, as well, but that seemingly didn't occur. What are we anticipating in terms of signaling for the next steps? Where do we push forward if they are going to deem it a success story from what they've at least learned on the test?
Yeah, totally. Yeah. So we were expecting an all-hands style talk after the launch, and there was just no mention of it, no mention of canceling it, or if it would happen at a later date. But yeah, so SpaceX really does emphasize this philosophy of flying, failing, and then fixing it. So that's kind of what Musk was saying about using the data to iterate again, make those fixes, fly more. And so recently the FAA authorized that SpaceX would be able to do more launches. So I think they're really thinking about ramping up the launch cadence, learning more, flying more. And so we can expect a lot more test flights in the future.
Sada Pashanka, we thank you very much indeed. Meanwhile, coming up, NATO looking to add cybersecurity to its latest spending target. We'll discuss that with Wendy Whitmore, Palo Alto Network's Chief Security Intelligence Officer. That's next. This is Bloomberg Technology.
NATO has proposed including cybersecurity as part of its new defense-related spending target of 1.5% of GDP. Here in the US this week, there is a House Committee Homeland Security field hearing on the future of America owning the cyberspace. Wendy Whitmore, Palo Alto Network's Chief Security Intelligence Officer, is a witness at that hearing and joins us now in San Francisco. Clearly for Western alliances, but also America, the role of cybersecurity in the national interest in defense is more prominent. Give me the basics of the hearing and why you have been called as a witness to it.
Yeah, so we're excited that the hearing is happening in Silicon Valley, and the focus of the hearing today is on technology innovation. So I think there's no organization that's doing more of that, especially when it comes to AI, than Palo Alto Networks, and we'll be really focused on what is it that the government needs to do to make security more actionable. And one of those areas is taking technology and focusing on outcomes. So the president, for example, should have a daily dashboard that shows civilian federal agencies how quickly are they responding to attacks and detecting them, and that should be as transparent as possible.
You said the president should have, which indicates to me that when in the cybersecurity context, this hearing is a step in the right direction, but you feel that the administration and our government generally can do more to own cybersecurity on behalf of the nation.
Well, I think the challenge that I was getting at, and it's certainly within the government, but also within civilian organizations, is security is too complex and visibility is not centralized. And that's really what we're focused on is, hey, let's create technological capabilities that then drive these outcomes so that those answers are clear and precise.
Wendy, that dashboard, I'm so intrigued as to what it would show, because if I'm right, the numbers are extraordinary that Palo Alto Networks blocks every day 31 billion cyber attacks. So what ultimately would the transparency look like?
You are right. And one statistic that's, I think, even more staggering is that up to 9 million of those every day are brand new and have never been seen before. So what we would encourage that dashboard to look like is focused on the time to detect and the time to respond. We work every day with organizations throughout the world to drive those times down. And in one organization we recently worked with, they took that mean time to respond from 3 weeks down to 19 minutes. And that time matters. When you can get it down into a number of minutes, you are now changing an outcome because that attack can no longer be successful.
I mean, the Committee on Homeland Security calls this discussion Innovation Nation and leveraging technology to secure cyberspace. The innovation, is it all about AI at the moment, Wendy?
It's certainly a huge part of it, right? We at Palo Alto Networks spent $1.8 billion last year alone in R&D, much of it focused on AI. So we're absolutely looking at how we can use AI to turbocharge defenses and make sure that we're driving the time down, and that organizations throughout the world are also implementing AI securely.
In the broader theatre of defence technology, we often talk about how the private sector and public sector work together. For example, different private organisations, Anduril on the hardware side and Palantir on the software side, will work with the national defence apparatus. How does that work in the sort of software cybersecurity space as a coalition of private companies and government entities?
Well, what's critical, as you point out, is that those partnerships remain stronger than ever between the government and between civilian organizations. And so what we're focused on is how we can provide actionable data and insights into our government partners and agencies to make sure that they can continue the defense of the country.
What are the main risks that they currently fend off? For a layman such as myself, it's still phishing that seems to be incredibly purposeful since Gen AI has come on the scene. But where are the threats particularly coming from, in what form?
Phishing is more powerful than ever, as you mentioned, because Gen AI has made communication capabilities even less of a barrier to entry. But I think what we're seeing are attacks from throughout the world, certainly from our adversaries in countries like China and Russia, that continues to occur. So we're focused on how do we make sure organizations we work with can defend those,